Today in this video I am analyzing companies which are into petroleum refining and marketing. The companies I am analyzing today is Reliance Industries, Indian Oil Corporation, Bharat Petroleum Corporation, Hindustan Petroleum and MRPL. The results for all of these companies are up to date till June 2019. Let us analyze these companies using graphs. In these ratios, I'll be asking a series of questions and we'll try to answer those questions. Wherever there are formulas for a particular ratio, I have indicated it on the top right hand side. Let us ask the first question: which company's share price is most expensive after we equalize with the face value? None of the companies' face value had any split. The face value for all of these companies is 10. So in that sense, the price for Reliance is the most expensive per share. I'm not considering the number of equity shares in this case. Purely based on the face value, the most expensive is Reliance. BPCL is quoting at 354 rupees and HPCL is quoting at 247. The cheapest stock available is MRPL at 51 rupees per share. Next, let us look at what is the percentage fall in price from where the price was 1 year back. So the price 1 year back for Reliance was 1418 and it has fallen 9% and currently it is quoting at 1288 rupees. So the current price is indicated in orange bar and price 1 year back is indicated in the green bar. The highest fall was seen in MRPL. Price 1 year back was 91 rupees and currently it is quoting at 51 rupees per share. That is a 45% fall from where the price was 52 weeks back or 1 year back. Both IOCL and HPCL have seen a 26% fall in the price from 52 weeks high. BPCL saw a 16% fall in its price. So here, the lower the fall, the better or stronger the stock is, and higher the fall, the weaker is the company's stock. The fall also creates an opportunity for us to buy into the company provided all the ratios are intact. If we buy at a very high price, then we stand at a disadvantage because if the price doesn't increase from there, then most probably it will fall and we can lose a lot of our money if we invest at top. So we have to look for a high drop in price along with good fundamental ratios still being intact. Let us look at what is the profit these companies are earning or generating on each share for the current share price. This is done by looking at the earnings yield percentage, and the formula we use is earnings per share divided by the price multiplied by 100. Reliance Industries per share cost was 1288 and it was earning 67.9 rupees per share as profit in 2019. That is an yield of 5.3%. IOCL gave an earnings yield of 11.8%. That is on a price of 126 rupees. The profit was 15 rupees per share. BPCL's earnings yield were 11.2%. HPCL's was 17.8%. And MRPL's earning yield was very less at 3.8%. That is on a price of 50.6 rupees per share, the profit generated was just 1 rupee 90 paise. So higher the earnings yield, the better the stock is, because on whatever price we pay, the company is generating a high profits. The lowest profit was generated by Reliance and MRPL. Here we are trying to understand how these companies' share price is quoting at compared to different variables. Next, let us see how many times more are we paying for the earnings of the company per share of the latest year. This we'll look at by using the ratio price earning, and the formula for that is price divided by earnings per share multiplied by 100. This is exactly opposite of the earnings yield, where we divide EPS by the price. Here we are trying to understand how far away the price is compared to the earnings, or how much more we are paying for the earnings of the company. RIL's price was 1288 and its earnings was 67.9 rupees per share. That is, we are paying 20.3 times more for this earnings of 67.9 rupees by paying 1288 rupees. So we are paying around 20.3 times. For me, my benchmark is that I should not pay more than 25 times the earnings. IOCL was quoting or available at just 8.5 times its earnings. BPCL was available at 9.9 times. HPCL was available at 5.6 times. And the most expensive was MRPL, available at 25.1 times its earnings. This has also gone slightly above my benchmark. So here what has happened is, for a price of 50.6 rupees, the company's profits of the latest 2019 year was just 1 rupee 90 paise. So that is a ratio of 25.1 times. So we should not pay a very high multiple for the earnings of the company. Next, let us look at where the current price earning is compared with its historical price to earnings ratio of last 5 and 3 years. Here we are trying to understand whether the current PE that we are paying is justified, and whether is it below the historical PE of both 5 and 3 years. The current price earning for RIL is 20.3 times, whereas historically in the last 5 years, on average, it was trading at 13 times more. In the recent 3 years, indicated in blue, the price earning was 14.6 times. So definitely in the recent price earning value, we see that it is expensive at 20.3 times. And it is higher than its both 5 and 3 years historical price earning data. IOCL current price earning is 8.5 and below its 5 years historical price earning of 10.7 times. It is also below its last 3 years price earning. BPCL was also in a similar condition. Its current PE is 9.9 times and lower than last 5 years average. It is slightly above its last 3 years average. HPCL current price earning is below its both 5 and 3 years average. So we are getting it at a good valuation. Of course, we also need to look at other ratios as I mentioned earlier. MRPL's current PE is 25, and since last 5 years, on average the price was quoting 16.3 times higher than its earnings, and in the recent 3 years it was quoting at 16.9 times. So here we will have to wait for the price or either the price to fall down or the earnings to go up for the price to earnings to reduce below 25. Next, let us look at whether the net profit the company has shown has that got converted into cash, whether the company can account for that net profit in actual cash, and how much of the cash that was received from operating activities was used to buy assets. So after reducing that, what is the free cash left for financing activity? Let me take a moment here and explain what is the operating activity. Operating activity is that activity which the company uses to produce goods and services. Investing is where it buys assets or sells assets of the company. And financing activity is basically paying off dividends, doing acquisition, paying off loans, and so on. So here we are trying to understand if the earnings are actually getting converted into cash, and after investing in fixed assets, how much is left over as free cash to be used in financing activity. This is all per share based values. RIL's profits per share was 67 rupees and the company received cash of 72 rupee, which is higher than what it showed as profit. This happens because the company also reduces from its profit or from its operating profit interest cost, depreciation, taxes, extraordinary items, includes the payments which is not received from customers who have bought on credit, or gives expenses or shows expenses which have not been incurred in cash, like buying on credit from suppliers. So when you remove all these non-cash incomes and expenditure, we get the cash from operating activity, which is the CFO. So this is the actual cash that the company received through operating activity. So this value is very important. Out of that cash of 72 rupees per share, the company spent 74 additional, along with this 72 that it earned, it spent 74 rupees additional per share on buying of assets. So the company's investments in assets is very high. It is even higher than what it earned in cash in the latest year of 2019. So the way I look at it is this way, that the cash coming in should be more than what the company is showing as profit. First of all, that. Second is, the company should not be investing more than 50% of its cash into assets, and the balance free cash left can be used in paying dividends, doing buyback, issuing bonus shares, or doing some kind of acquisition. The Reliance has invested additional, along with this 72 rupees of cash per share, it has additionally invested 74 rupees in assets. So its investments in assets is very high, as I mentioned earlier. IOCL profit was 15 rupees and it received around 15 rupees in cash also. So it is almost the same. So we know that whatever profit the company is indicating, that is actually getting converted into cash, or the company is actually receiving cash for the profit shown in the P&L account. And its free cash flow left per share was 4 rupees. That is, it has spent more than 50% of its cash into or doing investments in assets. So this is also not good. Although if we look in the sector wise, then this makes sense, because most of these companies are capital intensive, or they have to invest in assets continuously to increase their production and sales. BPCL's profits were 39.7 rupees and the cash coming in was more than that profit of 46. So this is a good indicator. but the free cash flow was zero, and it used more of that 1 rupee 60 paise into purchase or investing in assets. So again, not a good sign. Most of these companies, if you see, have a very less free cash flow left with them. HPCL's profit was 43 and cash coming in was 56. Again, a negative free cash flow of 17 rupees per share. That is, it already utilizes 56 in assets. Along with that, additional 17 rupees was invested. MRPL's profit was 1 rupee 90 paise, but the cash coming in was 6 rupee 90 paise. And its free cash flow was 1 rupee 40. Again, not a good indicator, because this is also more than 50% used up in assets. The reason that I'm explaining this particular chart in detail is that this is very important to understand whether the company's profits are actually being received in the company as cash or not, and how well it is investing in assets and how much it has left over as free. This graph is very important to look at. I'll also be analyzing the 5 years profit and comparing it with 5 years of cash flow from operations and 5 years of free cash flow later on in the analysis. So most of these companies are receiving more cash than the profit, but since they have to do heavy investments in buying of fixed assets, therefore their free cash flow is going into negative for almost all of these companies. These values are of 2019 and on per share basis. Next, let us look at what is the price we are paying for this operating cash flow. That is, how many times more are we paying for the cash flows from operations of the latest year. Here, I'm not looking at per share value, but in totality. That is, the entire market cap of the company, if you wanted to buy, you would have to pay 8,16,000 CR. On that, the company's cash of 2019, that is the profit earned in cash, was 45,724 CR. That is, if you wanted to buy this company based on the cash it generated in 2019, you would have to pay 18 times more. Here too, like price earning, price cash is very important. In fact, it has even more higher criteria for me than price earning. For IOCL, we are paying 8 times more. That is, the company's cash coming in was 14,000 CR in 2019, and its entire market cap, or the company's entire value in the market, was 1,19,000 CR. BPCL was available at 8 times its cash earnings. HPCL was available at the lowest 4 times its cash earnings, and MRPL was available at 7 times its cash earnings. If you had observed earlier, in price earning, MRPL was quoting at 25 times its earnings, but in terms of cash, it is quoting at just 7 times. So it is generating good amount of cash, and against that cash, the company is available at just 8,868 CR against the cash earned of 1,203 CR. So that's a multiple of 7 times. So all of these companies are available at a very good multiple to cash. Next, let us look at the price and compare it with the free cash flow. How far away the price is compared to the free cash flow per share or in totality. So here we are looking at how many times more we are paying for the free cash flow of the latest year. RIL's entire market cap or value of the company in the market was 8,16,000, Against that, the company doesn't have any free cash left. In fact, it has used up additional 47,000 CR in investment in assets. So that is a negative 17 times. So it's not a good value. IOCL's free cash flow was 3,800 CR, and this is again of 2019, and its entire market cap was 1,19,000. So that's a multiple of 31 times against the free cash flow. Here too, we don't want to pay more than 25 times the free cash flow. BPCL's free cash flow ratio was again negative at 224 times, a very high multiple. That is, on the company's market cap of 76,000 CR, the free cash flow was negative 344. HPCL's multiple was minus 14 times, and MRPL was available at 37 times its free cash flow. So if you want to buy the entire company of MRPL based on the free cash flow, then you would have to pay 37 times more. So this is also expensive. So this is all valuation metrics or ratios that we are looking at to understand how expensive or how cheap we are, if we are buying, how expensive or cheap we'll be buying into the company. Next, let us look at how many times more we're going to pay against the book value of the stock. Here we are looking at the price to book value multiple per share. Book value is basically a value of the share as per the company or as per the company's records. The book value is calculated by selling all assets and paying all liabilities from that money, and whatever is left out is the net worth or the money which will go to the shareholders. So that is the book value. So we want to understand what is the market cap and what is the book value per share. Reliance's per share value was 1,288, and as per the company's records, per share value was 610. That is, we are paying 2.1 times more than what the share is actually worth as per the company. Here, I don't want to pay more than 2.5 times the book value. Many companies would trade above 2.5, but then those are companies to whom the market investors have given that premium, so they have justified that multiple. But for me, I would want to wait and buy below 2.5 times. Many investors would want to even buy lower at 1.5 times the book value. So it all depends on what is your risk-taking capability. IOCL is available at 1.1 times its book value. BPCL is available at 2 times its book value. HPCL is available at 1.2 times its book value. MRPL is trading at discount to its book value. That is, the company is saying that its shares are actually worth 56.9 rupees. But the market participants have discounted that, and they are trading, or they are quoting the share price at 50 rupees. So it has even gone below what the company is indicating that its shares are worth. This again creates an opportunity to invest in the company. Of course, all ratios being in their proper order. If any of these ratios don't match up, then this price is not justified. If the market or market participants have discounted this stock, there has to be some reason for that. But if this is just a mismatch or a sentiment issue, then this is a very good opportunity to buy into the company. Let's move on and look at other multiples. Next, let us look at how many times more we are paying against the sales of the latest year. That is, the ratio would be the price to sales ratio. Here we are trying to understand how far away the price is compared to what the company did in sales in the latest year of 2019. RIL entire company was available at 8.16 lakh CR, and the sales it did in 2019 was 5 lakh 95,000 CR. That is, its market cap or the price of the company was 1.4 times higher than the sales it did. This is a very good ratio to look at because it will help us understand whether the company is generating sales as high as what it is quoting in the market. So a ratio which is near to 1 or less than 1 is a good opportunity to understand whether the stock is trading at a premium or at a discount. IOCL's price to sales ratio is available at 0.2 times, meaning the entire company was available at 1,19,000 CR, whereas it was generating a sales of 5,30,000 CR. So it's generating more than what it is quoted in the market. So this is a very good company in that sense that its sales are so high, yet in the market it is quoting at just 1,19,000 CR. If somebody wants to buy this company based on the sales it is doing, then this is a very good opportunity. So we can also say that the sales, or for that matter, market cap is just 20% of the sales. So this is trading at a discount. BPCL is also trading at a discount to its sales. Its entire company was available for 66,000 CR, and the sales it was generating was 2,98,000 CR. Same was the case for HPCL, where it is just quoting at 10% of its sales. MRPL is also quoting at 10% of its sales. So the most expensive in terms of price to sales was Reliance at 1.4 times. Rest all of these companies' sales are higher than its market cap. Next, let us look at the price earning multiplied by price to book product. This is Graham's formula. It says that the product of the price earning and price book should not be more than 22.5 times. That is, the PE can be maximum 15 and price to book value should be maximum 1.5. We should not pay more than this values for any company. This is a more conservative approach than what I use, because I use a PE of 25 times and a price book of 2.5 times. So if someone is more conservative, then they can use this particular ratio and not buy more than 22.5 times if the product of these two is 22.5 times. RIL's PE into PB was 42.8. That is, the current 2019 price earning was 20.3 and price book was 2.1. So the product of these two is 42.8. So it is more than Graham's formula. IOCL was quoting at 9 times, which is very reasonable, below 22.5. Its price earning was 8.5 and price book was 1.1. So this is a good valuation. BPCL was also quoting at a good valuation of 19.3 times. As I mentioned, this is more conservative than what I keep as my benchmark. HPCL was available at 7 times. Price earning was 5.6, price book was 1.2 times. MRPL was very expensive at 22.3 times, slightly below the Graham's formula. So although it should have given a positive thumbs up sign, but since it's very near to the, and also the price earning is quite high at 25 times, but it is trading at a discount to its book value. So either we can use this formula of the product of price earning to price book, or we can use individual price earning price book and see what is our comfort level as to how conservative we want to be. Next, let us look at the compounded growth in net profit over the last 5 and 3 years. How is the profit growing since past 5 years and past 3 years? Reliance's profits in the last 5 years has been growing at 13.9%, which is very good percentage. My benchmark is 10%. That is, the sales have to be growing at 10% year on year on average since last 5 years or last 3 years, or even year on year. In the recent 3 years, the growth in profit has fallen to 10%, but it's still good. IOCL also had a good growth in its net profit for both 5 and 3 years. BPCL's 5 years has seen a growth in profit of 14.7%, but in the recent 3 years, the profits have seen a degrowth of 1.3%. That is, what the profit was 3 years back. From there, currently, in the current year, that profit has fallen from what it was 3 years back. HPCL's last 5 years growth was exceptionally high at 43.3 times. So whenever we see such high growth rates, we have to look at the base year, that is from 5 years back. What was the value? Was it because of that value that we are seeing these kind of high growth rate, or was that value a justified value and the company is actually growing its profits at this percentage? So that has to be taken into consideration. In the recent 3 years, the profit is growing at a reasonable rate of 12.4%, although it has fallen from where it was 5 years back. MRPL has seen a fall or a degrowth in its profit from both 5 and 3 years. 5 years back, what the profit was, from there it has been falling at the rate of 7.3% year on year. And in the recent 3 years, the degrowth is much faster at 25.6%. So this is the most poor performing company in terms of earning profits or growing its profits. Next, let us look at if the price paid for the earnings is justified, and is there growth in that earnings over the last 5 years. This we look at by using a ratio called PEG of 5 years, that is price earning divided by the profit growth rate of 5 years. So here we are trying to understand what is the price we paid for the earnings, and if that earnings is growing over the last 5 years, and if it is growing, at what rate it is growing. So then that will help us understand if we can expect to recover our capital faster. Reliance's price earning was 20.3 times, that is, investors were willing to pay 20 times more against the earnings of the company. Now, is that justified? We are getting a profit growth of 13.9% since last 5 years. So we can use this as a benchmark to understand if the company can grow its profit in a similar manner. So although we are paying 20 times, we are also getting a growth rate of 13.9%. So we're getting a PEG of 1.5, that is dividing 20.3 by 13.9. My benchmark for PEG is that it should be less than 1.5 times. Many investors want it to be even less than 1 to make an entry. IOCL was quoting at 0.54, which is good, for a price earning multiple of 8.5, we are getting a high growth rate of 23.9%. That is, the PEG has fallen to below 1 at 0.4. So this is a very good price earning we are paying, because we are also getting a high growth in earnings. Same is the case for BPCL and HPCL. Both are quoting at 0.6 and 0.1. For HPCL, we are paying the lowest multiple of 5.6 times, and we are also getting the highest growth in profit of 43.3%. That's a PEG of just 0.1. MRPL's PEG is negative at 3.6. We are paying a very high multiple of 25.1 times against the earnings, but we are not getting any growth rate in that earnings. In fact, there's a degrowth in the earnings since last 5 years of 7.3%. So we get a negative 3.6. We don't want to look at we don't want to see a ratio which is more than 1.5. Whenever the ratio exceeds 1.5, it means we are not buying at a good price earning multiple first. Second is that anything above 1.5 means it will take us longer to recover our initial capital. And we don't want to see a negative value in terms of PEG. Whenever we see a negative value, it means there is a degrowth in profit. Next, we will look at PEG of the last 3 years. That is price earning divided by the profit growth of the last 3 years. The question we are asking here is the price paid for the earnings justified? The same question that we asked earlier. And is there growth in the earnings over the last 3 years? So if the answers to both of them is yes, then we can buy. RIL's price earning multiple of 2019 was 20.3. This is not a price earning multiple of 2019, but it is a price earning multiple of the recent 12 trailing months. And we are getting a profit growth rate of 10%. That is, the PEG has increased to 1.9. So in the 5 years, we saw that the PEG was reasonable and below 1.5. So it was a good buy. But in the recent 3 years, there's a fall in the profit, or the growth rate in the profit has decreased to 10%. So therefore, the PEG has gone up to 1.9. So either the price earning as a ratio has to come down, or the profit rate has to go up for the PEG to fall below 1.5. IOCL is still good at 0.5. Even in the recent 3 years, we are getting a 16.3% growth rate in the earnings, for which we paid 8.5 times more. BPCL in the recent 3 years has seen a degrowth in its profit at the rate of 1.3%. So the PEG is negative 6.9. So although we are paying 9.9 times, the earnings doesn't have any growth, or in fact there's a degrowth in the earnings. HPCL PEG is still good at 0.5. For a price earning of 5.6 times, we are getting a growth of 12.4%. Although I am explaining each of these ratios in detail for each company, as we move on, I'll be going faster and faster, and we'll try to skip some of them. But the ones which are very important, I'm stressing on that. For MRPL, in the recent 12 months earnings, we are paying 25 times. And we are getting a degrowth of 25% in that earnings or profit. So that's a PEG of -1. So we don't want to buy into a company by paying a very high price earning multiple, and that also not getting any growth in that earnings, or worse, that seeing a degrowth in the earnings. So up till now, we looked at the valuation metrics, that is how far away the price was compared to different variables like earnings, book value, PEGs, price compared to sales, price compared to cash earnings, price compared to free cash flow. Let us look at what is the compounded growth in sales over the past 5 and 3 years. RIL's sales has been growing at 5.5% since last 5 years. My benchmark is that just like profit has to grow at 10%, the sales also has to grow at 10% on average every year. Not all sectors and all companies will manage to grow at 10%. We cannot expect all companies to grow at 10%. Although I've given negative to most of these companies, as we can see, all companies in the recent 5 years, there has not been much high growth in sales. Although I've given them negative, when I give them scores after I do this analysis, at that time we'll rank them as per what was the growth rate in their sales. All of these companies' sales growth in the recent 5 years was below 10%. In fact, MRPL saw a degrowth even in its sales of the last 5 years at 2.4%. In the recent 3 years, although it has managed to pick up the sales again and grow at 16.8%, which is a good sign. From 5 years back, the sales has seen a degrowth of 2.4%. RIL's sales in the last 5 years was growing at 5.5%. As we saw earlier, these companies are huge in terms of size, and therefore to grow its sales at the rate of 10% would be little difficult, or it will be little unreasonable to ask for a 10% growth rate in sales. So even a 5% growth rate in sales is very good for a company which has a huge market cap or net worth, or in fact sales as well. In the recent 3 years, the sales has picked up to double digit of 27.6%. Now we can see when we come to 3 years, most of these companies have managed to pick up or grow their sales above double digit. So IOCL has grown in the recent 3 years its sales by 15%. BPCL has seen 16.7% growth in its sales. So again, when the recent 3 years are concerned, most of these companies have managed to pick up or grow their sales than where it was 5 years back. So this is a very good sign that in the recent 3 years, the sales have been increasing for all of these companies. So the higher the sales, the better it is, because that is the starting point from where we can judge how efficiently the company's management is. If it is managing to increase its sales, then it shows that there is demand for the company's products, or at least the management is doing something correct to see growth in sales. This is also the starting point from where it trickles down into the net profit. Next, let us ask, what is the net profit these companies are generating on the shareholders' equity or shareholders' money over the past 5 years and in the latest year of 2019. The formula we use to calculate return on equity is net profit divided by the equity plus reserves multiplied by 100. Here we are trying to understand what is the profit the company has generated on the money we have given or we have invested into the company as equity. My benchmark for all of these companies will look at what is the average of these 5 companies, that is how much it is generating on average on shareholders' money, and then look at individual ratios. So on average, since last 5 years, all of these companies were generating a return of 18.5% on the equity or shareholders' money, and in the recent 3 years it was generating 15%. So we will use this as our benchmark instead of using a fixed 15% ROE that I use in my analysis. So Reliance's ROE of the last 5 years on average, that is how much profit it was generating on shareholders' money since last 5 years, was 12.1%, and it is below its 5 years average for all these companies. In the recent 3 years also, in fact, in the recent 2019, the return on equity is 11.7%, fallen below its 5 years average, as well as all the companies compared average of 18.5%. So this is performed poorly. IOCL's last 5 years was generating a return of 16%, and in 2019 the ROE has fallen to 15.4. Although it is above 15, it has fallen slightly below its 5 years average, and yet it is still above its both 5 years average as well as recent ROE. That is, since last 5 years the return on equity was 16%, but the average was 18.5. So this has got a negative value. But in the 2019 the ROE was 15.4 and above the average of all the companies. ROE for HPCL is a very high 28.5 and 23.9%, which is very good compared to both the average of all the companies for 5 years as well as recent year. Even BPCL has seen a very high growth rates in ROE. Rather than growth rates, it is return on equity of 26% in last 5 years, and even in the recent year at 20%, above its industry's average ROE of 18.5 and 15%. MRPL has seen the lowest return on equity in the last 5 years at just 9.7%. Even in 2019, the ROE is very low at 3.5%. So that is why if we see initially when we looked at the price, it has fallen the most because the company is generating very low returns on the shareholders' money, and if the shareholders don't get good returns, they will exit from the stock and the price will fall. So this is also an important ratio to look at when investing into the company. Either look for at least a 15% return on equity, or at least look at above the average of the industry, where the industry's average return on equity is trading at. Next, let us look at return on assets. This is the EBIT generated, or earnings before interest and taxes deducted, that profit. On that profit, how much, or rather on the fixed assets the company has employed into the business along with working capital, on that, how much is the EBIT the company is generating. This is calculated by using the average of the fixed assets plus working capital of this year as well as previous year and dividing the EBIT by that. So we get return on assets. What we are trying to understand here is what is the EBIT generated on fixed assets and working capital over the past 5 years and the latest year of 2019. Reliance Industries last 5 years return on assets, that is the profit the company is generating on fixed assets and working capital, was 10.6%. Again, we can use the averages of the industry and compare that with the individual ratios, or we can give a benchmark to all of these companies that they should be trading above a certain return on asset percentage. My benchmark for ROA is also 15% and above. The industry ROA for these 5 companies, rather than industry, it is the average of these 5 companies, which is 15.1% in 5 years, and the recent average of these companies was 14.7%. So Reliance was giving a returns lower than what these 5 companies average was quoting at 15.1%. Also it is quite low, below 15%. So on its fixed assets and working capital, its EBIT is just 10.6% in the last 5 years on average. In 2019, the EBIT was 11.7% of the fixed assets and working capital. So here, this is low. IOCL, BPCL and HPCL are all generating a good ROA of more than 15% and also above the averages of all these companies taken together. MRPL's EBIT on the assets was 8.7% on average since last 5 years, and in 2019 ROA was just 6.9%. Here too it's the lowest in the group company and also below the peer group's averages. This ratio shows how efficiently the company is managing to generate profits on its assets, like in this case fixed assets plus the working capital. So all of these ratios are very important to look at to understand how efficiently the company is converting or generating profits on different variables. As we saw earlier on the equity, what was the profit being generated. Now we looked at what was the profit generated on the assets of the company. Next we'll look at the profit the company has generated on the capital employed. In this case, the capital employed is the total net worth of the company plus the borrowings. The net worth is basically the equity plus the reserves and any borrowed money the company has taken from banks and financial institutions. So here we are trying to understand what is the net profit these companies have earned on different sources of funds like equity, reserves and borrowings over the last 5 years and the latest year of 2019. Here too I want the company's profits generated on the capital employed should be more than 15% or at least above the average of the group companies. So the average of these group companies was 8.3% in last 5 years on average, and in 2019 the ROC generated by all of these companies on average was 7.7%. So we want the companies to trade at least above these average values. Again, IOCL, BPCL and HPCL, all three have managed and return on capital employed of more than above the average. Although these ratios are below 15, we cannot expect all companies to generate very high profits on the capital employed or sources of funds employed. So either we can take a 15% benchmark or we can take the company's averages. RILs and MRPL both were quoting or giving a very low returns on the total capital employed. Reliance was giving a return of just 6.6% on capital employed over the last 5 years on average. In 2019, the return was 6.3%. So it is very near to its average. IOCL's return on or profit generated on capital employed in the last 5 years was at 8.4% and above the average. BPCL was also giving a good profit of 12%, a double-digit return. HPCL also generated a good profit of 11.5% on 5 years average. MRPL has not managed to give a good return on the total capital of the company. In fact, in the recent 2019 year, the ROC is just 1.4%, way too low. That is why also these companies' price, MRPL's price, has fallen quite a bit, because it's not managed to generate a good amount of profits for the different variables like equity, assets, and capital employed. Next, let us look at the sales turnover on the capital employed. That is, how much capital was employed into the business. The capital employed in this case is the total source of funds of the business from the equity shareholders and from borrowings. And against that, what was the sales the company generated in 2019? The question we are asking here is how many times more is the sales compared to the capital employed into the business. RIL's capital employed into the business was 6,94,000 CR, against which the company's sales in 2019 was 5,66,000. That is a 0.8 time multiple. That is, the capital employed was higher, and on that the company managed to generate 80% of that into sales. IOCL's capital employed was 2,09,000 CR, against which the company did a sales of 5,28,000 CR, which is a very high efficiency. So on a lower capital employed into the business, the company is generating higher and higher sales. In this case, it has generated a sales of more than 2.5 times of what was employed as capital. BPCL managed 3.6 times higher sales than the capital employed into the business. HPCL saw the highest multiple of 4.7 times. That is, it generated a sales of 2,75,000 on a capital of just 58,000 CR. MRPL also saw a multiple of 2.5 times. That is, its sales were 2.5 times higher than the capital employed. The averages of all these companies was around 3 times. So anything below 3 would be considered a low value. Although IOCL's 2.5 times is also very high, I've given it a positive value. Next, let us look at how much of the net profit actually got converted into cash during the last 5 years. The formula we use is cash flow from operations divided by the profit after tax. So in the green we have net profit of the last 5 years in total, and in the orange we have the cash from operations during the last 5 years. So we are trying to understand how much of the net profit has actually been received in cash by the companies. Reliance's last 5 years net profit was 1,57,000 CR or crores, Compared to that, the company managed to get in cash of 2,39,253. The difference as to why the company has got more cash than the profit it has shown in the balance sheet can be accounted for by adding back depreciation, or if the company has done credit purchases, then we can add back, because they have not paid for the purchases they have done yet, but yet included in the net profit value or deducted from the net profit. Therefore, it is added back in the cash component. And that is why we see a higher cash compared to the net profit. So this is a good value. We want the cash coming in against the net profit to be more. Here, the cash coming in was 52% more than the profit shown by the company. IOCL's cash was 93% more than the profit of 74,316. Even HPCL has shown a 97% more cash coming in against the profit. The lowest cash against the profit was by MRPL, which is also good, because out of 3834 CR of net profit shown in the last 5 years, the company has received cash of 4,764 CR. So all of these companies have managed to gain in more cash than the profits shown in the P&L account. That is why for most of these companies, we'll see later that the net profit margin is low, but in terms of cash components, it is high. In this chart, we are asking two questions. First is, out of the cash which was earned from operations, what is the percentage of cash spent on investing activity, that is buying fixed assets? Second question is, how much of this cash is free to be used in the financing activity? So for Reliance, we have seen that it received a cash of 2,39,253 crores. Out of that, it has spent the entire amount in the last 5 years in buying assets. Over and above that, it has spent an additional 1,12,621 crores. So it has spent all of its cash in buying fixed assets. So over and above that, as I mentioned, it has spent an additional 1,12,000 CR. Where did it get this amount from? So that must have been done through borrowing from external sources like banks and financial institutions. So this is a negative value for Reliance, because for me, I would like my company in which I'm investing to not spend more than 50% in assets or buying of assets. And the 50% balance should be left out as free cash flow to be used in financing activity. IOCL had received a cash of 1,43,000 crores in the last 5 years. Out of that, it has 1,13,445 CR left over as free cash flow. That is, the balance of the two has been utilized in buying fixed assets. That is, just 21% of the cash earned was spent in buying of assets, that is investing activity, and the balance is still left as free cash flow. So IOCL has a huge amount of cash lying with it as a free cash flow, which it can use to pay dividend, bonus, or do buyback or do acquisition. BPCL has spent 79% of its cash into investing activity. So out of 62,000 crores of cash earned in last 5 years, it has spent 13,000 left over as free cash, and 79% of this 62,000 is used in buying of assets. So as we notice, most of these companies have invested heavily into buying assets and they are capital intensive. HPCL's investments in fixed assets was 63% of the cash, and 20,000 is left as free cash flow. MRPL has just 321 CR left over as free cash, and 93% of the operating cash flow was used in buying assets. So I consider, as I mentioned earlier, more than 50% being used in assets is a negative value for me. So in this case, HPCL has used up 63%, but I've still given it a positive because it is very near to around 50, or still better than the other other three companies. Next, we'll look at how much of the net profit was actually received in cash in the latest year of 2019. In the previous chart, we saw how the company managed to convert its profits of the last 5 years into cash, and out of that cash, how much was still left over as free cash flow. Here we are looking at the latest year's conversion of profit into cash. All of these companies have managed to gain higher cash than the profit shown in the P&L account in the latest year of 2019, except for IOCL, which has received less cash than the profit shown. That is, out of 17,000 CR of profits in 2019, the company has received less cash. So that is a shortfall of 19%. Rest all of these companies have managed higher cash than the profit. That is, most of the profits have got actually converted into cash, and the company has received that. Next, what is the growth in net profit of last 12 months over its 5 years average net profit? This would help us understand whether the company's current net profit is above the average or below the average of the last 5 years. RIL's last 5 years average profit after tax was 31,000 CR. Against that, in the recent 12 months, the profit was 40,000 CR. So that's a 27% gain above its 5 years average. So this is a good value. IOCL has seen a fall in its 12 months profit of 14,034 CR, which is a 6% drop below its 5 years average. BPCL has seen a mild growth of 1% over its 5 years average. HPCL seen a 18% growth in the recent 12 months profit after tax value over the 5 years average. And MRPL has seen a fall of 54% when compared with its 5 years average profit after tax value. So the highest fall was seen in MRPL at 54%. What is the growth in net profit of the last year over its previous year? That is, we are comparing the growth in profit from 2018 to 2019. So in 2018, the profit was 36,000 CR for Reliance, and in 2019, the profit increased to 39,648. That's a 10% growth rate, which is good. IOCL seen a 22% degrowth in its profit from its previous year. In 2018, the profit was 22,000, and in 19 it was 17,378 CR, which is a 22% drop from its previous year. Except for Reliance, all of these companies have seen a degrowth in its profit YOY, that is year on year. BPCL saw a 14% degrowth. HPCL had seen a 88% degrowth in its profit, and MRPL saw a degrowth of 83%, highest degrowth in profit from the previous year. Next, let us look at the quarterly analysis, that is on quarter. What is the growth in sales and profit from the same quarter of the previous year? That is, for all of these companies, we have the result up to date till June 2019. So we are comparing June 2018 with June 2019 quarter. RIL saw a growth in its sales by 22% YOY. That's a very good value. But the profit grew by just 7%. My benchmark is, I've done a little recorrection in the graph. So Reliance has seen a fall in its profit, in fact a growth rate of just 7%. My benchmark is that even quarter on quarter, the sales and the profit both should be growing at 10%. Anything below that is a negative value. Although in this case, since these companies are a large cap companies and they trade in volumes rather than profit, the margins would definitely be low. So the profit growth rate YOY for Reliance is 7%. In fact, it is the only company which has managed to grow in its profit by 7% YOY. Rest all of these companies have seen a degrowth in their profits. The highest degrowth was seen by MRPL in its profit YOY at 281%. Its sales also saw a degrowth YOY by 33%. HPCL saw a fall in its profit by 56% over its previous quarter. Although its sales had grown by 5%, the profit fell by 56%. BPCL's sales grew by 6% YOY, but the profit saw a degrowth of 44%. Similar was the case for IOCL, which saw a degrowth in its profit by 47%. So there's definitely some pressure on the margins of these companies compared to the previous year. So what we have done here is we have analyzed the growth rates in profit over the 5-year period, growth rate in sales over the period of 5 years in the previous graphs. Now we are looking at the very near term or short term picture as to what is happening in the company based on quarterly analysis. Next, let us look at how much is the contingent liability of these companies when compared against the net worth. And we don't want to see a very high contingent liability. Contingent liability is a liability which may or may not arise in the future. Also, another thing to keep in mind is that these liabilities are not accounted for in the balance sheet or P&L account. These are shown separately in the notes and they can arise anytime in the future. Therefore, we don't want to have a very high contingent liability percentage against the net worth of the company. My benchmark is that the contingent liability should not be more than 20% of the net worth. IOCL has seen a 25% contingent liability against its net worth. That is, the contingent liability was somewhere around 27,000 CR against the net worth of the company at 1,12,000. So this is high. Even BPCL's contingent liability is very high at 34% compared to the net worth. HPCL is at the borderline at 20%, and MRPL's contingent liability is 17% of the net worth, below the benchmark. Only Reliance has seen the lowest contingent liability of 7%. That is, its contingent liability was 27,000 CR against a net worth, that is the actual value of the company, at 3,87,000 CR. Next, let us look at the debt to equity ratio. Here we are asking two questions. One is the company funding its operations more through its own funds or borrowed money? And the second question is, what is the debt burden on the company? Reliance debt was 3,07,000 CR as of 2019, against which the equity contribution was 3,87,000, which is a good value because the debt is lower than the equity. We don't want the debt to equity ratio to exceed 1. That is, we don't want the debt to exceed the equity contribution. The lower the debt, the better it is, because that on that borrowings the company needs to pay interest, which affects the net profit, which would go ultimately to the shareholders. So the more the contribution of the shareholders, the more profit can be distributed within themselves. IOCL debt to equity is at the borderline of 1. In fact, this should be in multiple of. This should not be in percentages, it should be in multiples. So I have corrected these values. BPCL's debt was more than the equity, that is, debt to equity ratio was 1.1 times. The debt was 44,000 CR against the equity contribution of 39,000. We don't want to see these kind of high debt companies. HPCL's debt is again very near to the equity. MRPL has seen the highest debt to equity ratio of 1.6 times. The debt was 15,000 CR against the equity contribution of 9,900 CR. So we have to keep in mind that we don't want to buy into companies which have very high debt. Next is we'll look at how much debt the company is carrying and its ability to service the same from its net profit. Can the profit earned by the company pay off the debt, and in how many years can it pay it off? RIL's total debt, as we saw earlier, was 3 lakh CR approximately, and in 2019 its profits were 39,000 CR. That is, the debt was 7.8 times higher than the profit earned in 2019. I don't want the debt portion to be more than 7 times. This would also indicate that if we consider this profit to be constant over the next future years, then it will require around 7.8 years to pay off this entire debt. So this is a high value. IOCL's debt was 5.6 times the profit earned in 2019. So this is reasonable. We don't want the debt portion to exceed very high against what the company is generating as profits. BPCL's debt to profit was 5.8 times. HPCL had the lowest debt compared to the profit it is earning. Out of 28,000 of debt, the company's profit in the current year was 6,600 CR. That is just 4.2 times higher. So even if it has to clear off this borrowings or debt, then it will just require 4.2 years of current year's profit. MRPL has seen the highest debt of 15,618 CR against the current year's profit of just 353 CR. So that's 45.9 times. We have to understand this is the analysis of the current year's profit compared to the debt shown in the balance sheet of 2019. So this is the comparison of the recent year or the latest year. Next, let us look at the interest coverage ratio. Here we are asking the question how much interest the company has to pay on its borrowings, and would it be able to service it using the EBIT or the earnings before interest and tax. We use the formula interest divided by the EBIT. RIL's total profit of 2019, that is the earnings before interest and tax are deducted, that profit was 71,000 CR, against which it paid an interest of 16,495. That is, the EBIT was 4.1 times higher than the interest it paid. So we want this ratio, this is known as interest coverage. So we want the interest coverage to be as high as possible. My benchmark is it should be more than 4 times. In other words, the earnings before interest and tax should be more than 4 times or 4 times higher than what it pays as finance cost or as interest on its borrowings. IOCL earnings before interest and tax was 30,854 CR, against which it paid an interest cost of 4,925. That is, its EBIT was 4.8 times higher than the finance cost. So BPCL's coverage was very high at 8.3 times. It was earning 14,000 CR as the top line profit, and its finance cost was just 1,700 CR. HPCL had the highest coverage of 13.8 times because it had just to pay 786 CR on an earnings of 10,000. So this is a very good value. MRPL, as we saw earlier in the previous graph, it had a high debt of 1.6 times. That is, its debt to equity ratio was 1.6 times, and therefore its coverage is fallen below 4 times. It had earned a profit of 1,737 CR of EBIT, against which it paid an interest cost of 1,062. That is, its EBIT was just enough to pay its finance cost of 2019, and the balance goes into the depreciation cost and the taxes, and if there are any extraordinary items or losses, that has to be deducted. So therefore, as we saw earlier also, the net profit was quite low. So the borrowing, when it goes high, it automatically affects all the other ratios like net profit, the interest paid goes out higher, and so on. Next, let us look at what is the promoter holding and pledge share percentage. This is a very important ratio to look at. The question we are asking here is, what is the promoter's stake in the business? And do they have high incentive to keep running the business in an efficient manner? Have the promoters pledged any of their shares and taken loan on it? When the promoters pledge a high percentage of their shares as a collateral against the loan they take, then that basically means that the promoters' stake in the company has decreased, even though they have not sold it in actuality. But what happens is, if the promoters don't release that pledge, the banks or the institutions with which they have pledged these shares would generally sell it off in the open market, which would directly affect the price of the shares. And we'll see a very sharp fall in the price of those companies in which the promoters have pledged a high percentage of their shares. It is in an indirect way the promoters exiting the business without actually selling any of their shares. They've already pledged, for example, if they pledge 80% of their shares with banks, it means their holding is as good as 80% less. And we should avoid investing in companies in which the promoters have pledged a very high percentage of their shares. None of these companies, as we see, have pledged any of their shares. It's all 0%. None of these companies have any pledge. Let us look at the promoter holding. The highest promoter holding was seen in MRPL at 89%. Most of these are government companies run by government. These are public limited companies. MRPL's stake of the promoters was 89%, highest. The lowest promoter holding was seen in Reliance at 46%. HPCL doesn't have the promoter holding percentage because there's some issue with the promoter holding name being declared by HPCL. BPCL's promoter hold 53%, IOCL's promoter hold 52%. So we want the promoter holding to be as high as possible and above 30% at least, and a low percentage of pledged shares. For me, the benchmark is that the promoter pledge should not exceed 20% of the promoter's holding itself. This is a new ratio that I've added in my analysis from this video onwards. Here we are trying to understand what is the raw material percentage as a percentage of sales. That is, how well is the company managing its raw material cost. We don't want the raw material cost to exceed 85% of the sales. Even that is very high. RIL total sales for 2019 was 5,66,000 CR, against which its raw material cost was 70%. That is, out of this, the expenses on raw material itself was 70%. IOCL's raw material cost as a percentage of sales was 84%, still 1% lower than my benchmark. Rest all the three companies have seen a very high raw material cost compared to the sales. So out of the revenue it generates from sales, 88% has already been expensed out. So these are not good values. The highest raw material cost was for MRPL. This shows that the company doesn't have or doesn't enjoy a very high bargaining power in terms of dictating what the raw material price should be. So these are very high percentages for these companies. And when the raw material cost becomes very high as a percentage of sales, that directly affects the operating profit this companies earn. Next, let us look at the debtors to sales ratio. The question we are asking here is how much money is still pending to be collected from the customers or accounts receivables, also known as accounts receivables, against the sales of the latest year. So here we don't want the debtors or customers who still have to pay to the company to exceed 30% of the current year's sales. RIL's total sales, as we saw earlier, was 5,66,000 CR, but its debtors were 30,000 CR. That is, the company still has to collect 30,000 crores from its customers to whom it has sold goods on credit. But that is just 5.1% of the sales of 2019. So this is a minuscule amount for the company. And if you see, most of these companies have a very low percentage as a percentage of the sales to be collected from the customers. Even MRPL has to collect just 3.8% from on its sales of 63,000 CR. The debtors were just 2,374 CR. So these are very good values. My benchmark is that the debtors should not exceed 30% or should not be more than 30% of the current year's sales. What happens here is whenever the sales or the debtors increases by more than 30% of the sales, it automatically means the company is not or still has to collect a huge portion of the sales of the current year from the customers, and it shows inefficiency. And when the money is not coming in, or a large portion of the money is not coming in through customers, would automatically mean that the company has to borrow more money or use some kind of internal funding to keep running the business. That is, its working capital requirement will go higher and higher. Here we are looking at how efficiently the company is collecting payment from its customers. So the question we have to ask here is, within how many days the company is collecting pending payment from the customers? Is it efficient in its collection days? As we saw earlier, Reliance's debtors to sales was just 5.1%. That is, the customers still to pay to the company were just 5.1% of the sales of 2019. And not only that, it is collecting these payments from the debtors within 19 days. So it's very efficient. Here in the blue, we have debtor days 3 years back. That is, 3 years back, how efficiently or within how many days the company was collecting the payment from its customers. So it was 6 days. Now that has increased to 19 days. Although this is a kind of inefficiency, but it could also mean that due to pressure on the company, it may be giving more credit to the customers. IOCL collection period has increased from 8, which was 3 years back, to 11 days. So here also we have seen the company is giving more credit to its customers. BPCL was collecting the fastest 3 years back in 4 days. That has doubled to 8 days. HPCL's collection days is stable at 8 days. Even 3 years back, it was collecting within 8 days from its customers. And the collection is not very high. It has to collect just 2.1% of current year sales. MRPL is taking 14 days to collect payment from its customers. 3 years back, it was collecting in 19 days. So it has shown efficiency. It has reduced the collection period. So all the values for these companies are good. This is also a new ratio that I've added in my analysis. I'm comparing the debtors with creditors. That is, how much debtors or customers are still have to pay to the company against how much the company has to pay to its suppliers. So here we have to ask two questions. Are the suppliers willing to give credit to the company? And what is the reputation of this company in the market? So the more the suppliers are willing to give to the company on credit, the higher the reputation of the company. If a company's reputation is not good, the customers won't give credit to the company. And in terms of debtors, how fast it is collecting, which we already saw earlier in the previous graph. So we compare the debtors with creditors. So for Reliance, we see a 3.6 times gap. That is, it has to collect 30,000 CR from its customers, and it has to pay 1,08,000 CR to its suppliers. Basically, it is enjoying a very high credit from its customers. Here I'm talking about actual value of goods that it still has to pay for. So that's a gap of 3.6 times between the two of them. So this can only happen if the company is enjoying good status in the market. IOCL's multiple was also 3 times. It had to collect 15,000 from its customers, and it had to pay 46,000 to its suppliers. So this is also good. BPCL is also good at 2.5 times. MRPL had seen the lowest multiple of 2.1. Against the collection from customers, it had to pay 4,915 to its suppliers. It could work both ways. If it's way too high, that could be a negative as well as positive. Here, when the company is receiving huge amount from suppliers to use, because this is interest free, so it doesn't have to pay any interest on the money received from creditors or goods received from creditors if it pays on time. So the ratios for all of these companies is good. Next, let us look at the profit margins of these companies on the top line. That is the operating profit margin of the last 5 years on average. And what is the NPM these companies are generating on the sales of the latest year, and then we'll also look at the preceding year or the previous year to that. That is 2019 and 2018. I want the operating profit margin for the last 5 years on average, or even the latest year, to be more than 15%. But as we can see, none of these companies have managed a 15% growth rate or a 15% margin in the top line. That is because the raw material cost, as we saw earlier, were very high for these companies, as high as 93%. We saw earlier that Reliance's raw material cost was 70% of the sales. That is, the balance was left out as the operating profit margin for the company. In fact, all of these values are low for all of these companies. But now we have to consider that as a sector, these companies don't enjoy a very high margins on their sales because they work on volume rather than profit margin. RIL's OPM of the last 5 years was 14.4%, the highest in the group. IOCL had an operating profit margin of 6.9%. Whenever the company's OPM falls below 15%, that automatically means that the NPM would also be affected because the company still has to pay interest cost, deduct depreciation expenses, pay off taxes. If any extraordinary gains or losses are there, that will be added into the calculation. So therefore, when we have a 15% OPM, that would automatically trickle down and reduce to approximately around 10% for the net profit margin if everything is in a proper order. So we see even the net profit margin for Reliance in 2019 was 7%, and in 2018 the net profit margin was 9.2. So there is definitely pressure on the margin also from 2018 in blue to 2019 in orange. IOCL's OPM was low, as I mentioned, 6.9% in the last 5 years. The NPM has also seen fall from 5.3% in 2018 to 3.3% in 2019. All of these companies' net profit margin has fallen. If you see, even the OPM is very low. So in terms of returns, that is profits generated, all of these companies are working on a low margin. So this is not a bad sign because as a sector, as I mentioned earlier also, these companies work on volume. In this graph, we are looking at the liquidity position of the company. That is how liquid the company is, and can it pay off its current liability or service its current liabilities using its current assets. In the green, we have current assets, and in the orange, we have current liabilities. And in blue, we have the working capital. And then we have the ratio of the current assets to current liability, that is the current ratio. RILs in 2019 had a current assets of 1,81,000. Current assets are those assets which can be sold off within this year, or which will be basically discarded or sold within the current year. And current liabilities are those liabilities which have to be paid within this year or this financial year, current financial year. So we see that the company's current liabilities were very high. In fact, 60% more than its current assets. So if it has to clear all of its current liabilities, it will not be able to. It will have a shortfall of 1,22,000 CR. This is its working capital requirement. It requires this much additional capital to keep running the business efficiently. So here we want the ratio to be more than 1 times. That is, we want the company's current assets. IOCL's current assets were enough to clear off all its current liabilities. That is, it still had 1,516 CR of additional working capital. That is, the ratio between the two is 1 times. BPCL's current ratio has fallen below 1 and it has a shortfall of 6,391 CR. Its current assets were 44,000 and the liabilities it had to pay within this year were 51,000. So there is an asset liability mismatch basically. Same is the case for HPCL, where its current assets are not enough to clear off its current liabilities. Although these liabilities will not occur at one point of time, it generally is spread over the whole year, and it will be gradually cleared off. But this ratio is just to understand what is the liquidity position of the company. Is it in a comfortable position to, if it has to pay all its liabilities at one go, does it have enough assets? HPCL had a shortfall of a working capital of 1 lakh CR. Its current ratio was 0.8 times. MRPL had a good ratio of 1.3 times. It had enough assets of 13,000 CR to pay its liabilities of 10,000 CR, and it would still be left with 3,400 CR of additional assets. Next, let us look at the accumulated depreciation on the gross block. Here, the gross block means the total assets of the company at its acquisition cost. This is the cost at which the company acquired all its assets, which have still not been completely depreciated. And then we have the accumulated depreciation on it. That is how much of this gross block till date has got depreciated or been transferred as an expense to P&L account. So the question we have to ask here is, what is the size of gross assets of the company at its acquisition or cost price, that is the gross block, and how much of this gross block is already depreciated? So the higher the gross block which is already depreciated, the better it is, because then we understand that most of the expenses taken to the P&L as depreciation has already been accounted for in the past years, and in the future years the amount of depreciation going to the P&L will not affect the profit. This will be much better, much clearer when we look at the actual values of these companies. RIL's total assets at its cost price was 5,96,000. This is the amount of asset it owns. This does not include the depreciation. On that, it has already depreciated almost 1,98,000 crores of assets. That is, it has already shown this much expense as depreciation in the past years in the P&L account, which is around 33%. So it still has to account for 67% of these gross assets as expense in the P&L account. So a lot of the expenses is still going to go to the P&L in the future years, and there will be always a pressure on its net profit margin in the future years. IOCL's total assets were 1,54,000. I'm going to analyze each of these companies in detail because this is an important ratio to look at, which not many investors go into. The total assets of the company at its cost price was 1,54,000. Of that, 26,000 has already been transferred to the P&L as expense, which is just 17%. So the company's cost in the future for depreciation purpose will still be very high. That is almost 83% of this 1,54,000 still needs to go to the P&L in the future years. BPCL is also accounted for only 17%. So a very high percentage is still requires to be depreciated in the future years. Out of the 59,000 of assets, only 10,000 has been depreciated. So the balance of the two, that is 49,000 crores of assets, will be expensed in the future years. So this will help us understand how the depreciation expenses are going to affect the future years' net profit and net profit margin. HPCL has accounted 21% of its gross block as accumulated depreciation, and the total accumulated depreciation is 11,000 CR. So the balance of the two still needs to be going to the P&L in the future years. So anything above 20 or 30% is good. In fact, the higher the depreciation, the better it is, which would then indicate that most of the expenses has already been accounted for, and in the future years it will not affect the net profit. MRPL has only accounted for 17%, just like IOCL and BPCL. So most of his assets still needs to be depreciated in the future years. Next, let us look at what is the net block. The net block is calculated by removing the accumulated depreciation, which we saw earlier in the previous graph, from the gross block, from its acquisition cost of acquiring these assets. So the question we have to ask is, what is the size of the net block or net assets after removing accumulated depreciation from the gross assets, and at what rate is the net block getting depreciated every year? So when we look at the depreciation rate in this case, we're trying to understand how this depreciation is going to affect the net profit value in the future years. Are the companies depreciating their assets at a high rate or at a low rate? And if it's depreciating at a high rate, then the profit goes down because it has to account for higher depreciation in the P&L account. And if the depreciation rate is low, then basically it is inflating its profit. RIL's total net assets after removing accumulated depreciation was 3,98,000. This assets will be going to the P&L over the future years as expenses. Of that, in the current year 2019, the depreciation shown was 20,000 CR, which is a 5% depreciation rate. So every year, if we consider this value as a constant or an approximation, around 5% is being depreciated. So that's a 20,000 CR of expenses going to P&L account in the future years as well, if the company's assets remain constant at 3,98,000. IOCL's depreciation rate was 7%. Same was the case for BPCL and HPCL, depreciating their assets at 7%. Here I've given them a positive ranking, although I would want the assets to be depreciated at a high rate of at least 10% and above. MRPL is depreciating its assets at just 5%. So out of this 20,000 CR of net block, 1,000 has been depreciated in the current year. This concludes my analysis of these companies using the graphical interface. We'll switch over back to the Excel sheet and we'll try to understand. I've already given them ranking and scored to them according to the value of these ratios. I have given a ranking from +5 to -5. If a particular ratio is not matching within my benchmark, I've given them negative ratings or a negative score, and the ones which are having the best ratios are given the highest value of 5, and so on till 1. I'll not be going into detailed analysis again of all of these ratios because I've already covered them in the graph. These are the same values which I have shown in terms of graph because it is easier to understand when we plot it into graphs. After I given them all the scores, I find that HPCL has got the highest points at 142, followed by IOCL at 122. Reliance has got 102 points and BPCL has got 90. The lowest score was by MRPL at 22 points. I won't be explaining each of these ratios again, as I've already done it in the graphical interface. Here I'll leave the page on for 5 seconds each, so if anyone is interested in noting down these values, they can do that. And then after giving the score, I've combined all of these ratios into 6 groups or 6 metrics, which I'll cover little later on. So if someone wants to note it down, they can pause the video and look at these numbers. So what I've done is all of these ratios totaling to 90 lines, I've grouped them into 6 different metrics: efficiency, cash flow, growth, return metrics, solvency metric, and valuation metrics. These are the group of ratios. In efficiency metric, I have combined asset turnover ratio, contingent liability to net worth, debt to equity. Here what we are trying to understand is how efficiently the companies have managed to turn over their assets into sales. What is the contingent liability against the net worth? What is the debt against the equity? And so on. So basically it shows efficiency in managing different variables. In the cash flow metric, I've considered cash flow against the profit after tax. How much of the profit has actually got converted into cash, and out of that cash, how much is used or left over as free cash flow. And even the latest year's cash flow from operation to profit after tax conversion. In the growth metrics, I have considered how the sales is growing, how the profit is growing from 5 and 3 years. What is the growth in the return on equity? How is the profit growing over its 5 years average? What is the growth in profit year on year, quarter on quarter? And what is the net worth of the company? In the return metrics, I have considered the earnings yield, return on equity of the last 5 years and the latest year as well. Return on capital employed for both 5 years and latest year. Return on assets, operating profit margin, net profit margin of both the recent year and the previous year. The dividend yield. In solvency, I have considered what is the promoter shareholding, have they pledged anything, what is the current and quick ratio. In valuation metrics, I have considered the price to earnings of the latest 12 months, price earning historical of 5 and 3 years. Where is the price compared to OCF, compared to free cash flow, compared to book value, compared to its sales? What is the PG of both 5 and 3 years? So after combining all of these different ratios into groups, I have given them weightages as I find that efficiency should be given the highest weightage. How efficiently the company is managing different variables or different resources. Then how much of the profit which it is declaring is actually getting converted into cash. What is the growth in the company has been given 4th highest ranking or importance. Return metrics is given the 3rd highest importance. Valuation wise, I've given it the lowest weightage because only when these different metrics are in order we should look for the valuation. We should look whether it is at a reasonable price so that we can buy into the company. So in terms of efficiency, HPCL has got the highest points, totaling to 300 according to the weightage, and Reliance has got 210 according to the weightage of 6 points. So what I've done is I've multiplied 6 by 35 to get 210 and 6 by 350 to get 300 points. So each value or each ratio or each metric has been given a score according to its weightage. In terms of cash flow, HPCL has done very well by getting 35 points in total, and IOCL has got 40 points. So these companies have good conversion rate. RIL's cash flow metric has got 0 points, and MRPL has got 15 points, the lowest in the group. So RIL, as we saw earlier, although it has converted most of its profit into cash, but it has also utilized most of its cash into buying assets. So that is why in totality it has got 0 points. In terms of efficiency, MRPL has got the lowest efficiency metric score of just 54 points. In terms of growth in profit, sales and net worth, we find that HPCL and Reliance have the best growth metrics, and Reliance has 172 points and HPCL has got 100 points. Again, MRPL has scored the lowest in all of these metrics and has got the lowest points at 39 in total. In terms of return metrics, here I'm looking at how the company is generating profits on different resources or different sources of funds. Here, Reliance has got the lowest point at 33 and MRPL has got a negative 24. In fact, MRPL has also got negative 44 points in terms of growth metrics. The best score is in terms of returns was by IOCL and HPCL at 57 points each. In terms of solvency or liquidity position, Reliance has done the worst at negative 10 points. Even BPCL and HPCL's solvency metrics are not good, although their promoter holding is okay, which is again a very important ratio to look at. But in terms of solvency, that is how quickly can it clear off its current liabilities against the current assets it owns, it has scored the least points. IOCL and MRPL have a good solvency metrics. Finally, in terms of valuation, how cheap or expensive the price of the stock is, we find IOCL and HPCL are available at the cheapest valuations compared with different variables like book, sales, and so on, as I explained earlier, earnings. Reliance is the most expensive along with MRPL at 18 and 20 points each. So to finally conclude, I find that HPCL is the best company in terms of different variable ratios at 530 points, followed by RIL at 423 points according to the weightage. This is the top ranking is as per individual ratios, and the bottom ranking is as per the weightage given to each metric or each ratio. So Reliance has got the second ranking at 423 points. IOCL comes close to third rank at 417 points. BPCL has got 345 points and fourth rank. MRPL has got just 39 points and a very weak stock at fifth rank. Thank you for watching this video.